Hello and welcome to the CNBC-TV18 Mumbai newsroom. I'm Sonal Buthra and with me is Pavitra Parekh. As always, you're watching Mutual Fund Corner. Well, last week, the Sebi released its consultation paper on total expense ratio across mutual fund schemes. This is to bring in transparency in the cost charged to unit holders. It basically accounts for the fees and expenses charged by AMCs to unit holders. What does it really mean? How will this proposal affect our viewers, the mutual fund holders, that is something that we'll address today. So lots to discuss and lot to understand today.
Oh, absolutely. And this is something that there's been so much discussion around anyway, right? But this is difficult to understand for someone who's not been tracking the space. So to, help us break it down, really explain what this means, we have with us two very special guests. Anand Dalmia is co-founder and chief business officer at Fisdom. And we have Mohit, who is joining us in the studios. He's chief executive officer at Moneyfront. Mohit, thanks a lot for coming down to our studios.
Thank you.
It's lovely to meet you and have you here in person. And, let me just start with this very basic question of try to explain this paper to someone who has not been following it. If you just have to break it down in simple terms and explain it to someone who is looking to invest, how does this really impact them as well?
Okay, thank you so much for having me out here. So, look, I think what Sebi has done is a landmark thing in terms of how mutual fund industry is operating in this country. If I were to summarize this paper, and at a very top level, I think it brings in a lot of transparency. It makes mutual fund expenses true to label, which means whatever is now being shown to the investor is actually getting charged to the investor. Till now, that's not the practice, right? So a lot of transparency, making it true to the label, and reducing a lot of inefficiencies in the distribution channel and trying to curtail a lot of malpractices which are prevalent in the system. So overall, in getting to invest in mutual funds will get a lot cheaper for investors. A normal retail investor will find his returns getting enhanced and significantly enhanced over a long period of time. A lot of churning will stop. So at a top level, I think Sebi is from one arrow trying to kill all the malpractices, is also trying to get the economies of scale, the benefits which the industry has reaped over last decade or so, is trying to get that passed on to the final customer. Till now, it is somehow getting pooled with the AMCs and getting passed on to the distributor, but it's not reaching the final investor. So I think it's a brilliant move and it solves a lot of inefficiencies in the system.
Okay, we take that point. So the total expense ratio could come down if this consultation paper is actually executed. Anand, let me come to you. So are we saying after this that it's a big positive for all class of mutual fund investors, whichever scheme they invest in? Say, what would the difference here be between the equity and non-equity segment, if you can detail that for us?
Look, if you see the consultation paper, there are two key themes why this paper was issued. As Mohit said, the first one was to bring better transparency on the expense ratios. And the second one was how do we pass on the accrual of this, benefit of economies of scale to the end customers. Now, as we go through the paper, there are some very interesting data that they've presented. They've shown that, a lot of the things that Sebi is trying to, take care of is actually on the equity side, because the equity side is dominated more by retail investors. And that's where the distribution plays a very critical part. As a result, the bigger impact of this entire consultation paper is actually on the equity side and not so much on the debt side. While they have laid out ceilings for both debt, equity and debt funds, but the impact is more on the equity side. It will benefit the investors. However, look, the AMCs also are there to run a business, and we'll see how they respond. But some of the follow-ups that can be there for debt investors in particular could be that today a lot of schemes don't charge the maximum possible TER. Now, as an AMC, when a lot of the cost comes to me directly and I have to take care of those, a lot of AMCs may resort to increasing all the scheme's costs to the maximum permissible TER, which may impact some of the debt investors. So we'll see how they respond, but on the face of it, it's very good for investors.
Okay, very good for investors. I think everybody agrees with that. Mohit, something we were talking about as well when this paper initially came out is that the commissions on NFOs are very high, right? And we've seen so many NFOs come through this year as well. What do you think this will mean for that? Are we going to see less fund offers now because the commission has to be brought within a certain limit?
Look, Pavitra, I think the good part about this paper is Sebi lays out everything with proper illustrations and numbers. So what Sebi paper says is from a period of April 21 to September 22, there were around 86 new NFOs which were launched in this country. They mopped up around 86,000 odd crores, and out of that, 27% came from existing schemes of the same AMCs, which means those were all switches, right? And why were those switches happening? It's anybody's guess, because obviously the commission income in existing schemes was lesser, and the commission income being offered on the NFOs was way higher, and the money was being churned, right? And rampantly being churned. 30% is a huge number, right? So what SEBI has proposed is that anytime you try and do these kind of switches, the lower of the two schemes, the commission applicable will be the lower of the two schemes. So whenever you do the switch, you will only get commission. From A to B, you will get the commission, which is lower between the A and B schemes, right? So this kind of curbs a lot of malpractices in the system and takes out that churning angle. Also, one important data point which SEBI laid out in the report was that almost 83% of the funds were redeemed within 3 years of holding. So nothing crossed, only around 3 to 5% of the money was over 5 years in aging, which again is a very testing argument in support of this entire thing, that new schemes were being given to the customers. And this, to stop this, I think SEBI has taken the right measure of curbing this commission. One important thing which they also put out is the commission will now be an increasing structure. If you lay out a 3-year structure, it has to be increasing in order or equal in order. It can't be that the first year commission is higher and then second and third year are lower. So it has to be either increasing or equal.
Okay, so that is an important point, because commissions through the supply chain, that will get impacted here. So Anand, the same question for you. It has proposed in a way that AMCs should be allowed to give it to the investors directly, right? The trades should be executed directly and not through a broker, so to say. Do you think that is a point in the entire chain that will get impacted? It will impact broking commissions in that case. It will be passed on to the entire value chain.
Look, what they've done is the first point, which is around how do we make the entire, TER or the total expense ratio more transparent. One of the points is there were certain expenses which were outside of this TER that AMCs were allowed to charge the customer. One of the key such expenses was the transaction and brokerage charges. So brokerage charges essentially that, what stocks they are buying, they were paying brokerage for that, whether it's stocks or F&O. And this was charged to the customers. Now they have brought this inside. Now SEBI paper says that last year it was 3,300 crores was the total, around 3,300 crores was the total expense that, the AMCs paid as brokerages. So SEBI is now saying that, there can be something called limited purpose membership for the AMCs. They can have a membership with the exchanges and do this for themselves so that they have to pay lower cost. But it is not mandatory for them to do it. They can still use brokerages, but the cost has to be borne by them and will not be borne by the investors. So it will be part of the total expense ratios. So will it impact, the broking community? I think it can impact the broking community. Will it impact the profitability of the AMCs? Given the quantum here, it can impact the profitability of the AMCs, especially for certain schemes like arbitrage schemes, especially for the way certain AMCs work. Like there are certain AMCs which have a higher churn. That's the way they operate, or that is the model. So they will have an impact. So scheme to scheme, AMC to AMC, there can be a higher impact, but the customer will be protected because it will be within the maximum permissible TER that's laid out. So it can impact the profitability of AMCs, but customer will be enjoying a higher return, hopefully, because the expenses would come down.
Just to follow up on that, Anand, if they are also submerging or subsuming the brokerage charges in total expense ratio, it would be a bigger impact on the broking community rather than AMCs, right? They can always pass it on to the broking community and just recover that amount from them.
Look, we'll see if you look at the revenue of the broking community, it is some 25,000 odd crores. And, what AMCs are paying is around 3,300 crores. So it's 10%, around 10% of the entire revenue that the broking community makes. While certain brokerages will have a higher impact. But having said that, SEBI has not made it mandatory for AMCs to have their own brokerage. So I think a lot of them will continue to use these brokerages, but they may not pay the same brokerages that they were paying in the past. Because in the past, the brokerages that SEBI has laid out in the paper, that it is beyond what are the normal market rates. So maybe, we'll see a reduction of profitability on brokerages that are dependent on AMCs, for their revenues.
Okay, got that. Anand, another question, and I want to get Mohit's thoughts on this as well, but let me come to you first. Is there a possibility of a variable expense ratio as well? Because currently what we are seeing is that it's given as per different AUM levels, right? But do you think that this can be based on a performance of a scheme? Do you think that would make sense for now?
Look, it looks very interesting that, just like some of the other products which are for HNIs today, like, an AIF or a PMS, where these things are allowed, that, the distributor or the AMC makes money basis the performance, certain hurdle rates. I think in the consultation paper, Sebi has laid out. Good thing is it will be first tried in a sandbox, because there are two various ways in which they're suggesting. They're saying that you can charge the same expense, in simple words, that of a passive fund, and if you perform well over a hurdle rate, which is basis a certain benchmark, then you can charge a certain additional basis your performance. Now, this performance, how do we calculate it, how do we implement it is not that easy, because these are open-ended funds, and the fund manager invariably is taking a call for the long term. Now, if a customer takes out money in a year's time, well, the fund manager is investing for 3 years. How do we do it?
Maybe you can have a minimum investment period after which this becomes applicable, something like that.
Yeah, so we'll have to see how it's implemented. Second is the benchmarks available, right? So different schemes today are using certain benchmarks which are close, but they're not absolute benchmarks that every scheme has. So we'll have to see how do we come up with such benchmarks. And the implementation for small investors, how do we calculate what is the cost that it adds? It has been tried in a few countries. It's not been so successful for open-ended schemes. So we'll see how the implementation of that happens. But I'm happy that it's being done in a sandbox, which will help us come up with a very clear implementation way and, think through some of the challenges that will be there so that, it can be implemented. I think this is the best way possible, because it creates an alignment for the AMC with the investor. Because Sebi also shared a lot of data around underperformance of a lot of schemes compared to the benchmark. So I think, this solves a question that a lot of people talk about. Why should one invest in mutual funds or active mutual funds if they're underperforming the benchmark? So I think it's a good move. We'll see how it gets implemented. Hopefully in the sandbox we'll have answers for that.
Execution is the key, right? It's a great idea, as you said, but we'll see. So Mohit, same question for you. Do you think it makes sense performance-wise, TER? And also, since Anand also spoke about it'll be different for different schemes, benchmarks are different, but would it also mean that, say, X fund is doing better than Y fund, so the X investor will have to pay more charges here then?
Look, honestly, I think this kind of a practice globally is prevalent only in private equity and hedge fund industry. Yeah. The profit sharing concept per se is not prevalent anywhere globally in the mutual fund industry. So Sebi is trying it. So good luck. But I think it's a very complicated calculation, as Anand also mentioned. It's not very easy to compute it at a retail investor level. But when it comes to performance, I think it's a hard fact. And truth be told, for a 10-year data, and Sebi puts out the data vividly in the paper itself, says only 40% of the schemes have outperformed benchmark or equaled benchmark performance. 60% have actually underperformed the benchmark. And the underperformance is extremely stark when it comes to large cap funds. So it's all the way glory for passives, right? So implementing this is a good step, right step in the direction that fund managers are pushed, but it can also needlessly push fund managers to take aggressive calls. So you also have to understand at the backdrop of it, this is all retail money, money hard earned, and when fund managers are doing dramatic calls with this kind of money, it can enhance the overall risk in the system also. So I think they'll have to weigh everything. As Anand rightly said, it's on the sandbox, and they have to test out many philosophies before they actually take it to public. They have actually put out two mechanisms in terms of how this will get implemented. But in case it comes out, I think from an investor's perspective, answering your second question, it's a good move. Honestly, I think investors either might end up paying less at the start when they enter the scheme, and they will pay only at the time of redemption. If they are earning profits, then they might not feel that pinch. If you're making decent amount of profits, you don't feel the pinch to pay out. And if you're not making profits, then you've obviously paid less through the lifespan of the scheme, right?
It might also encourage you to get in more, right? I mean, it's kind of safeguarding your
absolutely. I think all these measures will go a long way in boosting the equity culture in the country. Honestly, when the costs go down, and that's a known concept across globally, when volumes tend to infinity, the cost comes to zero, right? So any industry you see, whether broking or anywhere, they've all the costs have got lowered over a long period of time. So from an investor's perspective, a profit sharing where fund managers' skin is in the game in terms of whether their earnings they're able to make that much money or not, and if their incentives also linked to it. I think finally it's a win-win for all in the system, but it's a tough implementation. It's a tough road ahead.
Okay, tough, and maybe a while away from where we are right now. But Mohit, Anand, it's been a very interesting chat so far. We have lots more questions as well, but we're going to quickly take a short break and come back. We'll continue our discussion in just a bit. Welcome back. You're still tuned into MF Corner here on CNBC TV18, and we still have with us Anand, Dalmia as well as Mohit Gang to talk about Sebi's consultation paper on the total expense ratio. We've been discussing this for about a week now. Mohit, we've spoken about a lot of the positives, right? That this can help the investors, it's going to bring down costs. Do you see any negatives as well over here in the, either in the product or in the switch and the sort of move to this kind of different TER?
Oh, totally. Look, any coin will have both sides to it, right? And it's a known thing that when you implement these kind of changes, you will have some marginal impact on various players. To begin with, I think the distributor fraternity, which is the biggest proponent through which the product is reaching the hinterlands of the country and is penetrating to a mass level, I think that might be a little disincentivized vis-a-vis other products. Even today, when you see, Pavitra, margin compared to an insurance product or any other product also, let's say a bank deposit, not a bank deposit, but a corporate deposit or bonds or any other product, the margins in mutual fund distribution are wafer thin, right? So the industry, Sebi argues that the industry has reached a particular scale over last 10 years. It's grown from 8 lakh crores to 40 lakh crores, but still the industry is not anywhere compared to the size of a fixed deposit industry or an insurance industry in the country. So the distributor margin shrinks. The incentive to sell rightly a mutual fund product, which is a very good asset to hold for a client, also decreases, and the incentive to push other products, which is insurance and your various other products, increases. So you will see an increased push in those kind of products. To me, that will be the biggest disadvantage. There are other side effects to the entire thing. I think the switches clause on the NFOs, which gives you the lower of the commission of the two schemes, if applicable, once a client switches from debt to equity, I think the paper is silent on that. The STPs which go in the system, which is systematic transfer plans from liquid funds to equity, will get hugely impacted if that happens. But I'm sure because it's a consultation paper and suggestions will go in, that should ideally get addressed. Right. So I think those are a few big ones. Other than that, I think industry still needs some boost to grow. Look, finally the participants in the industry, and no industry today thrives at a 50 bips margin, honestly, and you can go world over and kind of see how many industries survive with that kind of margin. It is boosting players who play at a scale. And the marginal players who are very small in the system might find it very difficult to sustain. New entrants in the distribution business will find it very difficult to come in because the entry barrier is too high. Your payback period to come in this business and make money is extremely large, right? So I think those are few disincentives.
Anand, similar question for you. We have spoken about the pros here, and important to highlight the cons as well. And also in this point that Mohit mentioned, that brokers were the one who would distribute it to hinterlands in the smaller towns as well, right? There is a cap on incentives for inflows from smaller towns as well. They would only get it for newer investors now as per the proposal. Do you think the distribution or the expansion that we are talking about mutual fund products would be impacted if it is actually executed?
Look, there are a few reasons why, I think it can get impacted. First is, this entire TR structure is now at a AMC level and not at a scheme level, right? And if you look at the AMCs which have a higher distribution ability, or, who are doing more work in the hinterlands, are largely the larger AMCs. Sebi has identified 8 AMCs. if you look at their, national spread, if you look at what is the work that they are doing more work. Now, if you bring the entire expense ratio at an AMC level, so the larger AMCs are going to be more impacted than the smaller AMCs. As a result, they may shy away from all the investments that they've been making to further penetrate the industry. As you can imagine, an AMC makes money on AUM and not number of folios. So for them to get smaller customers now may not be financially viable, and we not see AMCs putting so much effort. There's a lot of variable cost also that AMCs incur, right from KYC cost, transaction cost, payment gateway cost. Now, there has not been any effort made over the last few years to bring down some of these costs. So retail investing, as Mohit said, 50 basis, business. Retail investing for either an AMC or for a distributor is becoming more and more unviable. And I think, there is a third player in this entire ecosystem that Sebi should probably look upon the viability of a business model for them, which is the distributor. Now, when it comes to tier 2, tier 3 cities, there are a few things that they've highlighted here. One is they've said first-time investor to the industry. Second is they've said a maximum of 2,000 rupees. They've said that if the person redeems, then, that money goes back or claws back from the distributor. Now, the distributor can try and get the customer for the first time, but cannot take a guarantee to push the customer to be there for the whole year, right? So penalizing it for that may not be such a great idea. So again, it's a consultation paper, and I'm sure some of these points will be put forth to Sebi to ensure that, the efforts that are being made in the industry don't take a setback, and we continue to grow this industry from the current levels that we have to the next level. So I think there is, more viability of distributors and retail investors that need to be looked at.
Okay, all of those points are well taken, and like you've both been pointing out, this is a consultation paper, so I'm sure there's going to be revisions on this. The proposals will be reviewed. But thank you, Mohit, thank you, Anand, for taking out the time explaining this to us and really breaking down this consultation paper for our viewers, trying to explain what it means for different parts of the mutual fund ecosystem. But on that note, we're going to wind down on this edition of Mutual Fund Corner. Thank you guys very much for tuning in. We have closing bell up next for the final hour of trade.